March 2023. In 72 hours, 3 American regional banks collapsed. Silicon Valley Bank, Signature Bank, First Republic tottering. The Federal Reserve had to intervene immediately with emergency liquidity. Since then, your rent kept rising, your grocery bill climbed, your savings lost purchasing power. Central banks raised interest rates to fight inflation, but you're the one paying the cost. This isn't theoretical economics. This is your money. In this video, you'll understand exactly why central banks can no longer control the system the way they used to, how debt became the structure holding everything together, and what happens when that structure cracks. Because here's what they won't tell you. The cracks are already showing. Welcome to Financial Mechanics, where money becomes a system and systems reveal power. Central banks were never designed to manage climate policy, employment targets, and financial stability simultaneously. Yet today, that's exactly what they're asked to do. This isn't failure of competence. This is structural overload. The modern monetary system was built on debt. Debt fuels growth. Debt stabilizes crises. Debt buys time. But over time, debt stops being a tool and becomes a dependency. The most indebted actors become the most central. Not because they are virtuous, but because they are indispensable. The United States is the clearest example. The highest debt levels in history, yet still at the center of the system. Not because of discipline, but because of power, military dominance, technological control, financial centrality. In this system, being indebted is not a weakness. It is a position. Central banks are independent by design, separated from political cycles, removed from direct accountability. This separation once created stability. Today, it creates distance. Distance between decisions and social reality, between monetary policy and everyday life, between theory and consequence. Under Obama, balance sheets expanded to fight the 2008 crisis. Under Trump's first term, they expanded through tax cuts and higher spending. Under Biden, they expanded through stimulus programs and industrial policy. And in 2025, with Trump back in office, the trajectory hasn't reversed. Different presidents, same direction. At the end of 2025, the U.S. government again faced the risk of not paying federal employees on time. Not because money was unavailable, but because governance had become fragile. This is what transition looks like. Not collapse, not control, but imbalance. Transitions happen in two ways: slowly, through erosion, or suddenly, through shock. Central banks are not losing control. They're managing a system that no longer responds the way it used to. Power in finance is never abstract. It's built on precedent. In 1971, President Nixon closed the gold window. The dollar could no longer be converted to gold, not because the system worked better without it, but because the United States could no longer sustain convertibility. This decision was described as temporary. It became permanent. Why did the world accept it? Not because the dollar was strong, but because no alternative existed. The U.S. controlled global trade routes. It dominated technology. It anchored military alliances. The dollar remained central because the structure around it was indispensable. This is how financial power works. It doesn't rely on virtue. It relies on absence of choice. Decades later, the same logic applies. U.S. debt has grown exponentially, yet the dollar remains the reserve currency. Not because debt is sustainable, but because the system cannot function without it. This isn't stability. This is structural dependency. And dependency, when stretched too far, becomes fragility. If you want to follow how this transition unfolds, subscribe to Financial Mechanics. Because the next chapter is already being written. To understand why this shift is happening, we need to look at how the system was designed. Central banking was never meant to carry the entire weight of the economy. First, financial stability, then asset prices, then employment, then climate goals, then geopolitical resilience. The mandate expanded, while the tools remained the same: interest rates, liquidity, communication. This imbalance between responsibility and capacity is at the heart of the problem. When rates are low, debt accumulates quietly. When rates rise, the system trembles. Households feel it. Companies feel it. Governments feel it. Every decision becomes political, even when it's presented as technical. Central banks speak the language of numbers, but their effects are deeply human. Rent becomes unaffordable. Savings lose value. Jobs become fragile. This is why trust erodes. Not because people misunderstand economics, but because they experience its consequences. This is the reality Jerome Powell and central bankers worldwide face today. Raise rates too fast, trigger recession. Keep them too low, inflation persists. There is no perfect move, only trade-offs. And when trust erodes, control becomes fragile. The system still functions, but it no longer convinces. This is a subtle difference, and a dangerous one, because systems don't collapse when they stop working. They collapse when people stop believing in them. At the global level, this dynamic is amplified. The dollar remains dominant, not because it's perfect, but because there's no credible alternative. This gives the United States a unique position. It can borrow more, spend more, delay adjustment longer than anyone else. Other nations adapt around it. Some accumulate reserves. Some align strategically. Some challenge quietly. This isn't chaos. It's reconfiguration, a system stretching without yet breaking. We're already seeing the signs. In 2024, the Bank of Japan was forced to intervene repeatedly to defend the yen. Not because markets were irrational, but because decades of monetary expansion had created irreversible dependencies. In the Eurozone, inflation returned, not from demand, but from energy costs and supply fragmentation. Central banks raised rates, but underlying tensions remained. High debt levels, political fragmentation, structural imbalances. In the United States, Silicon Valley Bank collapsed in March 2023. Not from recklessness alone, but from interest rate shifts that exposed hidden fragilities. The Federal Reserve intervened. Liquidity was restored, but the message was clear. The system no longer absorbs shocks smoothly. It reacts. It compensates, but it doesn't stabilize permanently. History shows us that such periods are never stable. They're uncertain. They're tense. They're transitional. Central banks are not powerless, but they're no longer omnipotent. Their influence depends on expectations, credibility, and belief. And belief, once shaken, cannot be restored by policy alone. Central banks stand at the center of this tension, not as rulers, but as managers of an inherited structure, a structure built for another era. Understanding this doesn't make the future predictable, but it makes the present intelligible. And in times of transition, clarity is power.